If you're listening right now and you're still holding physical silver, pause for a moment. Not because you're lucky, but because you've already passed a test most people failed. Over the last few weeks, you watched the price fall without logic. You watched headlines flip overnight. You watched analysts laugh, dismiss, and declare the whole silver story finished. That wasn't random. That was pressure. Deliberate, calculated pressure designed to make you quit. And yet, here you are. That matters. Because what you just lived through wasn't normal price action. It was one of the most aggressive psychological shakeouts the metals market has seen in decades. The goal was never to correct the market. The goal was to exhaust conviction, to make holders feel isolated, embarrassed, and wrong. If you felt that, good. That means it was aimed at you. Here's the uncomfortable truth most commentators won't say out loud. Price is not the battlefield. Belief is. The market didn't need you to be wrong. It needed you to be tired, angry, doubtful. Because doubt leads to selling, and selling is how real assets move from weak hands to strong ones. You were never supposed to watch the tide, only the waves. Paper prices are waves, loud, violent, emotional, while physical ownership is the tide, slow, unstoppable, and indifferent to noise. While the screens flashed red, something far more important was happening underneath. Inventory was moving, metal was changing hands, and it wasn't flowing toward speculators or traders, it was flowing toward end users, manufacturers, and governments who don't care about daily candles. This is where the story changes. We're no longer talking about a temporary squeeze. That word implies relief, release, a return to normal. What's unfolding now is structural, strategic, permanent. This is a transfer. The Western financial system continues to flood the market with paper promises. At the same time, the Eastern Hemisphere is doing the opposite, absorbing real metal, ounce by ounce, without commentary or drama. One side is trading symbols, the other is securing supply. And if you're holding physical silver, whether you realize it or not, you're aligned with the second group. That's why the ridicule feels coordinated. That's why the narrative shifted so aggressively. And that's why the price action feels unnatural. Because this isn't about forecasting, it's about control. And control is slipping. The most important signals never appear on mainstream charts. They appear in premiums, deliveries, and who is no longer selling. And in the next part, we're going to expose the first undeniable proof that this isn't speculation anymore. It's strategy. Because the real evidence doesn't start in New York or London. It starts somewhere else entirely. And once you see it, you won't be able to unsee it. In part 2, we uncover the industrial choke point the mainstream refuses to talk about, and why one country now controls the most dangerous lever in the silver market. For years, you've been told the same surface-level explanation. Silver demand is rising because of green energy. That statement is true, but it's incomplete to the point of being misleading. Because demand alone doesn't move markets. Control does. To understand what's actually happening, you have to stop thinking like a trader and start thinking like an industrial planner. You have to ask a different question. Not who needs silver, but who controls the machines that cannot function without it. And the answer to that question leads us straight into the blind spot of the Western narrative. Solar panels are not optional anymore. They are infrastructure. Power grids, national energy strategies, military installations, data centers, all of them increasingly depend on solar technology. And inside every solar panel is a small but irreplaceable ingredient: silver paste. No silver, no conductivity. No conductivity, no panel. Here's the part that rarely makes headlines. One country now dominates the global production of those panels to an almost absurd degree. Not a majority, Not a strong lead, but an overwhelming concentration of manufacturing capacity. When you control the factories, you control the inputs. When you control the inputs, you control the flow. And unlike paper traders, factories don't speculate. They secure supply. This is where the market quietly fractured. On one side, you have Western exchanges trading synthetic contracts, claims on metal that may or may not exist in deliverable form. On the other hand, you have industrial buyers paying whatever is necessary to ensure uninterrupted production. That divergence shows up somewhere very specific. Not in headlines, not in analyst notes, but in premiums. Physical silver in Asia has been trading consistently higher than paper silver in Western markets, not pennies higher, meaningfully higher. In a functioning, honest market, that gap would vanish quickly through arbitrage. Metal would move, prices would converge. But that's not happening, because the metal isn't moving. The gap isn't closing, it's persisting. And persistence tells you something is blocking the flow. Either the metal can't leave, or it doesn't exist in the quantities advertised. This is the industrial choke point. Silver is no longer being treated as a tradable commodity, it's being treated as a strategic input. And strategic inputs don't get exported freely during periods of transition. They get stockpiled, restricted, and prioritized for domestic use. That changes everything. It means price discovery is breaking. It means Western charts are increasingly disconnected from physical reality. And it means anyone relying solely on paper signals is playing a different game than the one being decided behind factory doors and government policy rooms. And here's the uncomfortable implication. If silver is being secured for industrial dominance, then price suppression isn't a mystery. It's a necessity. Cheap paper prices delay panic. They buy time. They keep the illusion alive while the real supply quietly disappears. But illusions have a shelf life. And in the next part, we're going to look at what happens when industrial control collides with something even stronger: fear. Because supply isn't the only force pushing silver higher anymore. In Part 3, we step away from factories and into geopolitics, where conflict, energy shocks, and fear create a price floor no algorithm can break. Up to this point, everything we've discussed has been structural. Factories, supply chains, industrial control. That alone would be enough to keep silver under long-term pressure to the upside. But now we cross a line. Because markets don't move on logic alone. They move on fear. And fear has entered the system. Every major repricing event in history shares one common trait: a moment when the world realizes stability was assumed, not guaranteed. When energy routes are threatened, when supply chains fracture, when conflict stops being theoretical and starts becoming logistical. That moment is now. Energy markets are tightening, not because of growth, but because of disruption. When oil shipments stall, when production halts, when transport routes become uncertain, the ripple effect doesn't stay isolated. It spreads into every commodity tied to extraction, refining, and transport. Silver is one of them. Mining silver is energy-intensive. Diesel, electricity, logistics, security, none of it works without fuel. When energy prices spike or become unreliable, silver doesn't get cheaper to produce. It becomes more expensive, more constrained, and more strategically valuable. This creates something traders often misunderstand: a price floor. Not a technical support line, a psychological and geopolitical floor. When the world becomes unstable, capital stops chasing returns and starts chasing survival. That's when investors, Institutions and even governments rotate away from promises and into things that exist. That's the fear trade. It's the reason silver refuses to stay down even after aggressive sell-offs. You'll notice it again and again, sharp drops followed by stubborn rebounds. It's not optimism in doing that, it's anxiety. Every dip is met by buyers who aren't speculating, they're insulating. Fear buyers don't wait for confirmation. They buy because the alternative feels riskier. And this terrifies the institutions trying to control price. In a calm world, suppression works. Prices can be pushed down and kept there. But in a tense world, suppression becomes dangerous. Every artificial drop invites real demand. Every smash creates an opportunity for someone who sees the bigger picture. This is why volatility has increased instead of resolving. It's why moves feel violent but incomplete. The market is being pulled in two directions at once: paper pressure from above, physical urgency from below. That tension is not sustainable. And here's the critical insight. Fear doesn't need to be justified to be effective. It only needs to be believable. Rising conflicts, strained alliances, fragile energy routes, none of these need to explode simultaneously. The risk alone is enough to redirect capital. Once fear embeds itself into the system, it doesn't leave quietly. It hardens. It becomes policy. It becomes precautionary buying. And precautionary buying doesn't stop just because the price dipped $5. This is why silver behaves differently now than it did in past cycles. It's no longer just a hedge against inflation. It's a hedge against instability itself. And that brings us to the moment institutions dread the most. Because when fear demand meets structural scarcity, there's only one lever left to pull, and it doesn't involve fundamentals. It involves force. In next part, we expose the engineered mechanism designed to shake you out, the rule change meant to break conviction without changing reality. When pressure builds and fundamentals refuse to cooperate, there's only one move left for institutions that are trapped. They don't fight the market. They change the rules. This is the part of the story most people miss, not because it's complex, but because it's intentionally framed as boring, technical, administrative, something you're not supposed to question. Margin adjustments, risk controls, exchange policy updates, harmless on the surface, devastating in practice. To understand what happened, you need to understand how leveraged markets really work. When someone trades futures, they're not buying the asset, they're renting exposure to it. A small deposit controls a very large position. That leverage is what allows price moves to have such outsized emotional impact. And it's also what makes traders vulnerable. When exchanges raise margin requirements, they're not predicting direction, they're forcing behavior. By increasing the cash required to hold a position, they create a sudden stress test. Anyone who can't meet it is removed from the market, regardless of whether their thesis is correct. That's not safety, that's selection. The timing of this kind of move is never accidental. Rule changes don't arrive randomly. They arrive when positioning becomes dangerous to the system, when too many participants are on the wrong side of a move, when delivery risk increases, when confidence grows where it shouldn't. And that's exactly what this was. By raising the cost of participation, the system didn't attack silver directly. It attacked holders. It forced liquidations. It manufactured selling pressure without needing real supply. And from the outside, it looked like a natural downturn. But it wasn't. It was engineered stress. This mechanism creates a feedback loop. Forced selling pushes price down. Falling price triggers more margin calls. more selling follows, all without a single ounce changing hands. It's pressure without transfer. And here's the critical distinction. Physical holders don't feel this. Bars don't get margin called. Coins don't receive liquidation notices. Vaulted metal doesn't care about exchange policy. This entire maneuver only affects paper exposure, which raises a question no one asks loudly enough. If everything is under control, why is force required? Healthy markets don't need emergency rule changes. Abundant markets don't fear delivery. Balanced systems don't punish participation. Rule changes are a signal, not of strength, but of vulnerability. They reveal where stress is accumulating. They show you where the system is afraid pressure will become irreversible, and they tell you exactly which side of the trade is being protected. This wasn't done to protect stability. It was done to buy time. Time for shorts to reduce exposure. Time for institutions to reposition. Time for the narrative to catch up to reality. But time is the one thing scarcity doesn't respect. Every artificial suppression extends the imbalance. Every forced exit transfers conviction from weak hands to strong ones. And every attempt to control price through mechanics instead of supply only sharpens the eventual response. Because once confidence survives a rule change, it doesn't leave easily. And in the next part, we're going to identify who benefits from this pressure and how coordinated messaging reveals exactly where the system wants you to go. In Part 5, we decode the sell narrative, why institutions tell you to exit precisely when they need your position the most. When large institutions speak publicly, they are never talking to you, they are talking through you. This is the mistake most retail participants make. They assume reports, notes, and analyst commentary exist to inform. In reality, they exist to shape behavior. Markets don't move on opinions, they move on positioning. And positioning requires someone on the other side of the trade. That's why the most important question you can ask when you hear "time to exit" is simple. Who needs me to sell? Because markets are zero-sum at the transaction level. Every sale requires a buyer, and large buyers cannot accumulate quietly unless someone else is persuaded to give up their position. This is where narrative becomes a weapon. When institutions publish bearish outlooks during moments of stress, they are not forecasting collapse, they are manufacturing liquidity. They need sellers, not because the asset is weak, but because they cannot buy without moving the price against themselves. Think about the mechanics. If a large entity tries to cover exposure or build a position aggressively, price explodes upward. That reveals scarcity. That invites attention. That accelerates the very move they fear. So instead, they slow the process down. They release cautious language. They emphasize overextension. They highlight risk. They encourage patience, or better yet, exit. It's not advice, it's bait, and it works best after a shock. Rule changes rattle confidence. Volatility creates emotional fatigue. This is when messaging becomes most effective, not at tops, but during uncertainty. The goal isn't to convince you the thesis is wrong. The goal is to make you question your timing. Because hesitation leads to action, and action creates supply. But here's what breaks the strategy. The buyers in this market are no longer purely speculative. Industrial demand doesn't read analyst notes. Strategic buyers don't care about weekly sentiment. Sovereign entities don't use stop losses. When price drops due to fear or forced selling, these buyers step in, not emotionally, but opportunistically. They see discount, not danger. They see inventory, not headlines. That's why the market no longer collapses the way it used to. Each attempt to push price down meets real demand. Each engineered dip strengthens the base, and each narrative push reveals more clearly where accumulation is happening. This is the inflection point. When institutions tell you to sell into weakness, it's because they are trying to exit risk, not avoid it. They are repositioning ahead of a system that no longer behaves the way their models expect. And that leads to the final distinction you need to understand. Paper positions settle. Physical positions decide. In a stressed system, contracts can be closed, cash can be substituted, and rules can be rewritten. But ownership cannot be edited retroactively. Once supply tightens beyond a threshold, price becomes secondary to access. That's the transition we're watching. Not a rally, not a squeeze, a repricing driven by necessity. This isn't about predicting a number, it's about recognizing a regime change, one where price discovery shifts away from leveraged abstractions and toward physical reality. And when that happens, the loudest voices will be the most misleading, because they will need you to act before the system admits it can't deliver. So listen carefully to what's being said, and pay closer attention to what's being done. Because when the rules change, the narrative tightens, and real buyers refuse to leave, the outcome is no longer a question of if, only who holds when it does. If you understand this moment, you don't need constant updates. Watch the gaps, watch the premiums, watch who keeps buying when price is told to fall. That's where truth lives.